Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm joined by David Hunter, a Wall Street veteran with 50 years of experience under his belt and the chief macro strategist of Contrarian Macro Advisors. We're going to discuss the coming meltdown he sees in asset classes across the board, whether gold could buck the trend and be a safe haven while everything collapses, his thoughts about where to deploy capital in markets today, and so much more. I hope you'll enjoy today's conversation with David Hunter. David Hunter, great to have you back on the show. It has been 4 months since our last conversation, so before we dive in, I'd like to get an update. As we sit here today, what are the main themes and trends you're currently watching when it comes to markets and the economy that you think investors should be paying attention to?
Sure. Hi, Jesse. Great to be on again. Thank you for having me. My view hasn't changed that much in 4 months. I thought we'd get a year-end rally, and obviously that didn't really happen till today. But not a lot is changing out there. I think we're kind of slowly gravitating towards lower inflation levels and a recession ultimately. But with the election in the fall, it kind of stretched things out. I think the Biden administration put all kinds of things through the government to try to keep the economy propped up and help the Democrats in the election. Didn't really help them, but now we're probably going to have payback, I would guess, in the first half of this year, this coming year. So, but it doesn't really change anything because that's what I was expecting anyway. It's just kind of getting there a little more slowly. I think we are ultimately heading for a global bust still, and that I still expect that in 2025. I've said recently, I think what we're seeing in China, particularly with what you've seen in their interest rates and, basically in deflation now, I think they're leading edge of this global bust. They are more levered than anyone else. They have more excesses than anyone else. And, they're running into more problems than anyone else right now because of their dependence on real estate. And I think it's just a matter of time before the rest of the world catches up with that. So I think that's probably going to be the big story of 2025.
And regarding China, it's interesting to note that Xi Jinping recently gave his presidential address for the New Year's, where he emphasized that Taiwan was going to reunify with China. I'm wondering if you think, war is always an effective distraction. If you think these economic problems at home could potentially lead them to make a move on Taiwan or start some sort of conflict to kind of rally the citizens around a so-called noble cause.
Yeah, rally the citizens and distract the citizens from what's really going on. Certainly a possibility. I really have a hard time seeing us get into some sort of a serious war over it. There'll be a lot of, I think, rhetoric back and forth. I think we'll certainly help the Taiwanese with weapons, etc. I particularly under Trump, I just don't see us, and it's not because he's an appeaser. I just think he's going to look at it and say, we're not going to, put our citizens at risk and in war for something like that. The biggest problem we have is obviously Taiwan Semi is such a dominant player in semiconductors and the production of semiconductors that if we can delay this a couple of years, you're seeing new plants being built here by Taiwan Semi. So and other companies obviously stepping up with fabs. So that's really the issue for us in Taiwan. If it happens this year or in this next year, it will present a problem, I think. But I just have a hard time seeing us go to another stage in global war when Trump's trying to de-escalate everything. So we'll see.
Hey guys, just a quick break to hear from today's sponsor, ARC, Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Any thoughts on the debt ceiling debacle? Janet Yellen warning that unless extreme measures are taken, the U.S. government could default on its debt. Do you see that as a realistic possibility? What's your view there?
Yeah, I don't. And my whole, as you know, my whole thesis is that, um, we, as long as we have a printing press, we're not defaulting on the debt. The problem with the issue with default, I think, is a 2030s problem, because by then I think we lose our printing press simply because inflation's way too high and you can't print when, printing just leads to even higher inflation and a bigger problem. So, but we're heading towards deflation, in my opinion. Certainly have low inflation right now. So default is not an issue, in my opinion. Now, there may be a lot of rhetoric around it. There may be a lot of hand wringing in the next year over that. But ultimately, I as you know, I'm predicting 20 trillion in new money coming out of the Fed in response to a global bust. So, some of that will get moved up if we start running into, default risk. But I suspect the Biden administration is, and Yellen being part of that, and certainly a loyal part of that, they're just trying to make it difficult for Trump coming in.
Yeah, that makes a lot of sense. Is 2025, in your view, going to be the year that we see markets melt down, that we see the global bust? Obviously, timing things is almost impossible. The market can remain irrational longer than you can remain solvent. What are your thoughts there on what we're going to see in 2025 for the broad market specifically, and the greater scenario of the bust that you see happening globally?
Yeah, so my call has been for several years. We'll get this melt up, and then the bust and bear. So bust refers to the economy, the financial system, and bear market accompanies that to the tune of maybe 70 or 80% downside. Um, but we aren't done with the melt up yet. So my view, in spite of so much bearishness coming in here, very very near term, you have people calling for a top here, saying there's a lot of dangerous signs here, saying that the market is, we're seeing little breath. This correction of the last month has taken breath down. So there's a lot of people thinking we've seen the top. I don't believe that at all. I think everything I look at in my work says there's, one last parabolic melt up into a top. So I think could be a first quarter thing, could stretch into the second quarter, but I think the next 3 or 4 months is going to be probably the steepest, biggest rally we've seen to date. So that gets you to, my target is 7,500 on the S&P, 25,000 on the Nasdaq, 55,000 on the Dow, and 3,300 on the Russell. So the Russell from here is basically 50% upside. Dow, the Dow, the S&P, the Nasdaq, it's 25 to 35%, but that's a lot of upside still to go. It'll come in a short period of time, in my opinion, but it'll be a lot of return. And then I think as we move towards the middle of the year, you're going to start realizing that, hey, yeah, this economy's losing a lot of steam. There's, Europe and Asia obviously are already in trouble, and Canada is struggling. Australia is going to join that. So I think what we're going to see as we move through the year is that we first go into recession, and then recession turns into this global bust, which is, my definition of that is that it's something the speed of a recession, but far worse than our normal recessions, kind of 2008-9 on steroids. As I say, the banking system in this country got some religion because of what happened in 2008. But banks around the world, Europe, Canada, Asia, are in far worse shape now. And I think that's where you're going to see the biggest banking problems. But then, because it's such a small world now, we're all intertwined. There's plenty of counterparty risk. It takes us down too. I don't know about bank failures, other than regional. The real estate issue is going to probably come to the surface. But in terms of the big banks, I don't know that they get as bad as last time, but they certainly are not going to be going. They won't go unscathed.
Do you think Bitcoin will participate in this melt up rally? Having hit 100K not too long ago, there's a lot of excitement in the space. It's interesting because you have different schools of thought. There are those who say, well, Bitcoin's going up because of, government malfeasance and fiscal irresponsibility, debt and deficits. And there's others who say, actually, it's kind of more tracking the broad market than anything else and going up alongside the NASDAQ and the S&P in the same sort of speculative fervor that is chasing the Magnificent Seven. I wonder what your thoughts are on how Bitcoin will play out and perhaps other cryptos as well into this melt up that you see coming.
Yeah, as I've begged off many times, I don't follow crypto. I don't follow Bitcoin. But that doesn't stop me from at least opining. So take it with a grain of salt. But clearly this last move up where went through 100K was driven by the whole embracing of Bitcoin by the Trump administration. And it's a small market, relatively small market, with finite supply. And if it brings in more demand, as people say, oh, the Trump administration is going to go to Bitcoin and they're going to have a bring it in as a reserve and etc. It just meant as that got more people interested in Bitcoin, it drove price up. I don't know. You could argue that was kind of a speculative, like you say, speculative fervor, speculative blow off. I'm not sure. You could argue that was kind of a artificially driven run there, or you could argue that it's just getting started and you got another one of those coming. Either way, I think in the bust is where I want to see what happens. One reason I don't follow it is I say it's never really gone through even a downturn. We haven't even had a recession since Bitcoin's been around. So let's see how it holds up in the bust, and then we can kind of see what kind of staying power it has. I am concerned about some of these people that are the lead spokesman for it. The kind of hype artists in a way, and it feels, on the one hand, it feels a little tulip bulb like,
Yeah.
And then on the other hand, it does answer at least one concern out there, which is central bank control. It gets you outside of that. As I say right now, the reason I don't follow it more than anything is because it doesn't really have macro significance yet. If Trump embraces it and it becomes something else, if it grows in and doesn't have one of those blow ups in the bust, it may become something that has macro significance. But right now, it's a great investment. People misunderstand me. I said I'm not staying away from it because I don't see it as an investment. I just don't. It doesn't fit what I do. I'm a macro strategist, and it's not a solution. At least at this point, it's not a solution for what I think is coming in the world. The melt up into a bust that takes it into deflation. The response to that bust being massive money around the world that blows the system up to a point where it makes our governments vulnerable, that sovereign debt is vulnerable, and you collapse in the 2030s. I just don't think Bitcoin has the kind of significance to answer that. Now, it may be an answer for a handful of people or a small percentage of people, but right now it is not a universally held security. It's not a system unto itself. So right now it's just a good investment.
Yeah, that's a very nuanced take, very much appreciated because usually people either love it or hate it. I hold Bitcoin, but I admit that it's quite speculative at this point in time. It hasn't been tested, as you've mentioned, and there is this issue with the true believers. I don't know if I've ever seen people as fanatical as Bitcoin maxis online, which gives me cause for concern, as well as these people like Michael Saylor, et cetera, who are saying, the US should sell all its gold and buy Bitcoin and all this sort of stuff. So a very interesting take there. I want to shift to gold for a moment because I know in the bust and market collapse you see coming that you think it will affect all asset classes, including gold and other commodities, but that you see a super cycle for commodities on the other side of that. Could we, though, see a scenario where people turn to gold as a safe haven in a collapse of the broader market, in a loss of faith in fiat currency and government, fiscal management? Could we not see people look at that happening and run to gold? I mean, obviously, that's the big narrative out there when you talk to gold bugs that once the broad market crashes, which a lot of people believe it will, that people will then turn to, well, what can I hold in my hand? And they'll rush to physical gold. I wonder what your thoughts are there.
Yeah, I don't think so. I mean, anything is possible, I guess. But um, if you look, even in 2008, nine, it came back quickly, faster than the markets, but it did get hit initially, and I think that's what you can expect here. As I've said it, gold won't fall anywhere near as much as the equity market, in my opinion. Silver could. Silver's got more volatility to it, but gold, yeah, you probably see it down less and recover much sooner because the response to the bust will be massive money as well as massive fiscal response, government response. But that massive money response means people will probably take that as a signal that we got to get into gold again. So I'm kind of using it. I still think there's a big run in gold and silver here in the next 6 months. But I'm saying gold can get to 3,400 here before the bust, pre-bust, and then could fall back anywhere from its breakout point at 2,100 to mid 2,500. So if you do a calculus on that, it's basically saying it can fall by somewhere probably between 25 and 30%, something like that, which would be half or less, half or a third of what the equity market does. Silver, I'm calling for it to run to 75 from here. So it's at, 29. 29 to 75, and then back to at least back to here and probably back towards the low 20s, mid 20s to low 20s. So that one's much more volatile. And then post bust, I think the precious metals are going to lead the pack. I mean, you will see, I think, gold get to 20,000. So if it gets back to say 2,100 and then rallies to 20,000, almost tenfold move. And silver, I think, can get to 500. So, if it moves back to the low 20s and moves to 500, you're talking about, a 25-fold move. So there's, I think, a huge future ahead in the precious metals. They're, unlike the stock market, where I think the peak this next year, meaning that 7,500, if that's what it turns out to be on the S&P, the peak we see in this cycle is likely to stand for decades in terms of the indexes. There'll be opportunities within the indexes, lots of groups that will do well, commodity producers, et cetera. But the indexes, I think, because of much higher interest rates next cycle, you'll squeeze PE multiples, et cetera. So I don't think you'll revisit the highs of this next, probably see the highs in the first half of 2025, maybe even first quarter. Those highs probably won't be seen again this decade and maybe not next decade. Whereas with gold and silver, obviously, I'm talking about 20 plus fold increases in the metals, and obviously the miners will benefit greatly if that happens.
And we've discussed other commodities extensively on the show here in the past. I recommend people check out the other two interviews I did with you for all your thoughts on oil, uranium. I know you see a commodity super cycle coming on the other side of this bust. I do want to get your thoughts on Trump's presidency and how it could affect markets and the economy. Does Trump at the helm change anything about your thesis? Does it not really matter who's in office in the end? Is there anything he can do to kind of rein in the situation when it comes to debt and deficits? We've obviously got the Department of Government Efficiency. This harkens back to the Grace Commission, which wasn't able to accomplish much under Reagan because they couldn't get their proposals through Congress. I imagine a similar situation is going to play out here. What are your thoughts there?
Yeah, I actually disagree. I'm quite optimistic about what Trump is doing. He's coming in with a whole different understanding of Washington than he did, back in 2016. He's hitting the ground running, assuming most or all of his nominees get confirmed, and I think his cabinet posts get the people he wants. I am optimistic that Doge will make some significant cuts in government, and that we'll see a much more efficient government, 2 and 3 years from now. The problem is the macro trumps that. I mean, I'm talking about something we haven't seen in 90 years. You can call the Great Depression part of it was a bust. We did see massive bank failures around the world. And we did see, an economy that was far below any recessionary norm. So you could call that what I'm calling here. This one isn't going to be a Great Depression. It's not stretched out over a decade because they will print that money pretty quickly. But the damage that's done in that 12 to 18-month time horizon that we're in a bust is massive. And it not only is bigger than anything Trump can offset with, it also really short circuits some of what if he were coming in a normal time, if this were even 4 years ago or 8 years ago, and he were doing this, I'd be super optimistic because it's a very pro-capitalist agenda with pretty big deregulation, necessary deregulation, drill baby drill. So taking advantage of the resources we have in this great land, and cutting government, trying to reduce government's influence on the economy, which is usually a drag. Doing all of that, I think, 8 years ago would have led to, basically what people call the Roaring Twenties. I think you would have seen that. The problem is he's coming in at this time when we're approaching that bust, and yeah, he doesn't want to just print money like crazy, but that's what's going to happen. It's not because of Trump. It's not because of Powell. Every central bank is going to have no choice if they want to save the system. You can sit back and say, well, we're not blowing up. We're not going to pump the system up again like we did, and the mistakes we made last cycle. And that's what Powell's telling you, right? He's pretty adamant he's not going back to that QE solution again. That's easy to say until you're staring it in the face and the system is basically melting down. You're having a free fall in the financial system. They don't have a choice. It's the only tool they have where they can move quickly and stabilize the system. So whether it's 20 trillion or something less than that or more than that, that's my best guess of kind of 4 times what we saw in the pandemic, and every central bank around the world doing the same thing. That's way past anything Trump can do at the margin, right? I mean, that blows you out of the water. We were a central bank balance sheet of 875 billion back in 2008 before the response to the financial crisis. 875 billion was the largest balance sheet we'd had going back to was as big as we had gotten going back to 1913 when the Fed was put in place. And now we're talking, we got to 9 trillion during the pandemic, and we're talking maybe 30 trillion, by the time we get through the bust. I think people need to understand. We throw around numbers and they may hear 20 or 30. I'm not sure they hear the trillion after that, right? I don't know that we really can wrap our heads around something like that. So I really, as much as I'm very encouraged by Trump, I think he's very sincere in what he's trying to accomplish to bring America back to what it used to be, and make us the world leader again. I think he will be successful in some ways with um, you know, the military, getting the military back in shape, and you know, bringing down the world wars, bringing down the Ukrainian situation, hopefully resolving something in the Middle East. Um, I all of that people should be optimistic about, but we're this is 80 years in the making. We've had cycle after cycle where the excesses build up and to bigger levels, higher levels, and then it takes a bigger response to bring it back down from those excesses. And in doing that, they overshoot, and then that creates an even bigger next cycle. So you've had this ratcheting up of excesses, imbalances, and monetary response. So now we're at levels where I think um, what comes at you bigger and faster, and the response is bigger and faster. And I think we're just at that point where it goes off the rails. It just goes through the roof on the upside in terms of the melt up, the blow off in the market, and the excess build up. You get this crash in not just the markets but in the financial system, and it requires a far bigger response than we've ever had. We're operating in nowhere land, basically unprecedented territory. So no policymaker has ever been here before, doesn't know what to do. And part of what Powell's trying to do sincerely, in terms of saying we know the mistakes that were made in the last 10 or 15 years, we're not going to repeat those. We're going to be more cautious. We're going to do things more incrementally. Part of why we're going to have the bust is because of that, right? Because they're going to be slow to respond to what would normally would cause a quicker reaction. But they're going to say, no, we don't want to do that again. And in delaying it, you get an even bigger downside. And then ultimately, when they finally realize this thing's out of control, they have to come in with both feet, and we'll see numbers we've never seen before. So it's kind of I would call it almost inevitable that based on human behavior, you're fighting the last war, you're trying to overcompensate for what mistakes you made last time, and in so doing, you create even bigger problems.
Do you have any thoughts on the amount of passive inflows that are coming into the broad market via ETFs? I had Bill Fleckenstein on the show recently. He says this has fundamentally changed the market and made it much more difficult to predict when we could see an eventual correction, because there's never been a situation like this before where you have such a massive amount of capital that flows into this small handful of stocks. How do you think that is affecting the markets?
Yeah, I guess I don't necessarily buy that completely. I certainly do think the money flows and the passive money flows do influence things to some extent and do make it harder to shut things off or to things get delayed. I would certainly agree that that could be part of why this cycle is stretched out. But I think ultimately that only makes the fall bigger when it reverses. And then the amount of money it takes to blow it back up bigger. So that kind of fits into what I just said, I think, in from a money flow standpoint a little bit. I'm not in the camp that is so focused. I think very short term, meaning the last month or two, we're back on that mantra of this is a narrow market. Most stocks aren't participating. It's a magnificent seven, or it's a small cadre of AI stocks, or what have you. I think people are overreacting. That was true, obviously, for a period of time. The Mag 7 dominated a year ago or a year and a half ago. And that was certainly true. But under the surface, you were seeing things like industrials, and some other groups that were participating. So, people acted like it was seven stocks. It wasn't. There were other things that were doing pretty well. It just was those seven were doing so well that you could statistically say they were accounting for the whole move. But in a period of the time this year, middle of this year into the fall, we had a pretty broad market. The Mag 7s took a rest, NVIDIA took a rest, a lot of the semis took a rest. And you saw other groups come to the forefront. You saw some value start playing, and you saw the small caps actually come alive. The problem is you got to November, and we've had a consolidation since, and people are looking at that consolidation and drawing conclusions, I think, that are faulty conclusions, because yes, we're back to where it looks like we're back to, small cadre of growth stocks are dominating, et cetera. But I think you can't analyze during this last month, because it's a consolidation. It's partly a consolidation of the moves that those value stocks had. So I expect very shortly, in fact, I think it may start today or maybe next week. But I expect we're going to begin the next leg up after this 1 month consolidation, or whatever it is, 4 to 6 week consolidation. And I think we'll see this market get very steep and quite broad. As I said, I'm calling for 3,300 on the Russell. We got down almost 2,200 yesterday. That's 50%. The other averages are going to be up 30 or 35%. So we are, by definition, you're going to see a broadening. And a big part of that, the other part of what the last, basically the post-election period has been a backup in rates, right? People added 2 and 2 and got 6 in terms of Trump policies. They decided his policies were much more inflationary. Interestingly, I think, TDS, Trump derangement syndrome, was pervasive throughout even the economic community, and certainly the the CBO and the places that do these analysis. They're building in a bias towards saying, Trump's worse than Kamala, and the numbers are going to be more inflationary than Biden, et cetera. I don't believe that. I think going to a more pro-capitalist agenda and looking sincerely to shrink, move things out, like, eliminate the Department of Education and things like that. I think we're going to be surprised at how much that can offset. And I don't, again, this has been true really since Reagan, that people do not understand supply side economics. It is a legitimate argument, and I think it could be proven that it's happened over and over. You cut tax rates in a dramatic fashion. You alter tax approach dramatically by cutting taxes, and you get higher revenues. You don't get, they all use a static analysis to say, well, you're cutting marginal tax rates, therefore you're going to get less tax revenue. Absolutely false. The problem we've had, the reason deficits have continued to grow, has been spending, not tax revenues. Our tax revenues grow with tax cuts. So I think you're actually going to see better control of deficits. The problem is he has a big agenda, so there is going to be some spending there. So I'm not arguing we're going to go to surpluses, but I don't think it's nearly as dire as the bond market wanted to take it. And they drove interest rates up 100 basis points, pretty much on the basis of speculation about Trump policy being inflationary, and I think there is a bias in there that they just really think he's an idiot. But I think these are legitimate. It's a legitimate agenda with a very positive outcome, if not for the bust. So it might soften some of the bust if he succeeds. But I just think the macro trumps that. But anyway, going back to your original question, so I think that shrinking of breadth and the focus on saying the passive flows are going to a very small group of stuff. I think you're going to see in the next 6 months that's not the case. It's going to broaden out. You are going to see the value stocks come into favor. And it's not going to be, well, growth stocks and the Mag 7 go to sleep. I think they are going to come back. I think Nvidia is going to much higher highs. I have a 400 target on SMH, which is down around 240, 250. So in other words, I'm not saying it's at the expense of the growth stocks. I think both are going to play. This is going to be and it's kind of unusual because usually as you move to a top, you do narrow and you do get, you narrow right into a top where only a handful of stocks are driving the market, kind of the nifty 50 of the early 1970s. Um, but this one's going to be unusual in that I think we have the opposite. I think we broaden into the top.
Let's talk about the Fed cutting rates. We're in a rate cutting cycle. Their latest was a 25 basis point cut at the meeting in December this month here. And yet the 10-year Treasury yield continues to rise. This emphasizes something you've said before on the show, that the Fed doesn't actually have any control over interest rates. I think there's this idea out there that when the Fed cuts rates, automatically Treasury yields go down. How do you expect the Fed to react here? And what is the rise in the 10-year rate telling us?
Yeah, I don't think it's telling us a lot. I think the rise in the 10-year rate, and everybody got excited about that, and that's why the market's down, and et cetera. Um, I think the rise in the 10-year rate was, as I said, directly a response to Trump getting elected and fears that we were going to see more inflation, bigger deficits, um, and that was pretty pervasive across Wall Street. That was the kind of the popular narrative. I think what you had, people forget, we had a drop from 5% down to 360 in the preceding 6 months. And so you went 5 to 360 back to 460, some maybe a two-thirds retracement type of thing. You have a lot of calls now, as happens when the tape moves that way, for 5, 6, 7% tenure. I have consistently said, and didn't expect it, honestly, to get to 460, but I wasn't surprised by 440 or 450. But anyway, I've consistently said this is a counter trend move, and once it resolves, once it completes, we will see another leg down towards 3%, and ultimately, I think 250. And I am still saying, which I think I said last time on your show, I expect in the bust the 10-year to go to 0% and short rates to go negative. And again, you can see that if you're printing 20 trillion, if you're coming out with QE of 20 trillion, that means you have to be buying debt, right? They'll be buying every bond and bill they can get their hands on to put money into the system. At the same time, the government's still going to be, they'll be matching probably not dollar for dollar, but they'll be doing a lot of fiscal expansion. So there'll be plenty of new debt, but they'll be monetizing all the debt. So it won't be a problem of saying, well, there's big supply out there and nobody wants to buy it. No, the Fed will be the buyer of last resort because they're trying to get money into the system. And I say the Fed, but it'll be every central bank in the world doing the same thing. So I think we do have one lower low in rates. Everybody thought the 2020 lows, when 10-year got down to 0.4, thought that was the end. Everybody's consistent. I'd say 99.9% of people out there, pundits out there, analysts out there think we've seen the historic low in rates and we won't go back there. We're going higher, not lower. I think we have one more leg down to new lows. That will be the secular peak in bonds, the secular low in rates. And then I think what follows that over the course of the next decade will be rates moving to secular new highs, meaning above the 1982 or 1981 peaks when the long bond got to 15%, T-bills got to 21%. I think we'll exceed those by early next decade.
Wow, very interesting. So then when it comes to the fixed income market at present, would you be staying completely out of it? Is there anywhere that you think is providing decent yields, whether that's emerging markets, corporate debt, or would you be out of the fixed income market entirely? And then obviously if post bust, you're looking at 20 plus percent yields on treasuries, that would likely be a very good place to then be at that point in time. Is that how you see it?
No, quite the opposite. I think right now, keep in mind, interest rates going down means bonds going up. So,
Right.
so if I'm looking for rates to go, I'll just use the 10 year. If I'm looking for the 10 year to go from 460 to 2.5 in the next 6 months, let's say, um, that's obviously very bullish for a 10 year treasury. And it'll be very bullish for all long duration treasuries. Um, I also think it'll be bullish for, because I think stock market's going to be going up. People are going to be looking over the trough, even if the economy's slowing. They're going to be saying, "Yeah, but the Fed's easing, so we're going to factor in that by 2026 we're out of this and we're growing." So they're going to be positive for corporates too. So I think in the next 6 months, certainly the next few months, you can buy both government bonds and corporates. As we move closer to the end of this cycle, as the recession gets more and more, comes into vision, um, I think you need to move away from corporates and only stay in treasuries. And then if I'm thinking that as the economy goes into recession and then ultimately a bust, that you move from 2.5 down to zero over the course of many months, obviously there's only one game in town at that point. That's treasuries. You won't want to be in anything. You don't try to play spreads above treasuries. It'll be treasuries or bust basically. So there's a crossover point where you can own both corporates and treasuries now, but there's a crossover point where you'll want to move everything to just government guaranteed bonds because that's the only thing that's going to hold up in the bust. And then there's a point at which you want to say, nobody's going to be able to pinpoint this, or very few. So I'm not saying you do it to the precise moment, but you'll want to say at some point, rates are bottoming out. If it's zero, it's zero. If it's a quarter, it's a quarter. If it's negative, it's negative. But somewhere down there, rates are bottoming out. And I would not want to buy. Would not want to own a long duration bond going forward for probably the next several years. For the next decade maybe, um, government or otherwise. And at that point, your fixed income strategy is still kind of fixed income. Your fixed income strategy going forward from the bust, and you might be okay for a few months into the recovery, but going forward would be rolling treasury bills. So you buy 6 month bills, and every 6 months you'd be rolling them at a higher rate. Once that rate cycle starts ratcheting the other direction, and you do that for the balance of that, whether it's a 6 or 7 year cycle, and you'll start rolling T-bills at, let's say, zero or 0.5% in the first year of the recovery. By the time you get into the fifth, sixth, or seventh year of the recovery, you'll be rolling treasury bills at high double digits, and you won't be suffering the if you buy a bond, you're locking yourself into the rate you buy that bond at. So if you buy a bond at 1%, that's going to be a big loser as rates go to 14 or 15%. If you buy a bond at 5% and rates go to 14 or 15%, it's still a big loser. So staying away from bonds will help your portfolio immensely. And just understanding that you may have to give up early on. You're going to be choosing between, a bond yielding 1%, a T-bill yielding zero. But you're going to be better off in that T-bill because within a year you're going to be, or maybe even sooner, you're going to be having the T-bill out returning that 1% you locked yourself into on the bond. So staying away from locking yourself into rates when you're near the bottom is the absolute way to go.
Yeah, and another fantastic nuanced answer. Um, I guess my initial question was more related to the shorter end of the curve and holding to maturity, which is something that you're saying once we see rates start to go higher, you can roll over those shorter term T-bills, which makes a ton of sense as a place to park cash and just get a really good yield without locking yourself in for the long term. David, this has been a fantastic conversation. Thank you so much for joining us today. For those who want to learn more, where's the best place to go to hear from you? And also tell us about the Contrarian Value Advisor newsletter.
Okay, yeah, I'm on Twitter every day, and uh, taking the arrows for being bullish on metals right now, but I'm there pretty much every day. I do caution people that if you're on X or Twitter and you're not seeing me, it means your settings are not set for being notified of my replies, because most of my communication is in replying to other people. I occasionally put out initiate a tweet or a post, but most of it is in replies. So I just caution you, if you're saying, "Gee, I never see him on there. He must not be active," because I get that sometimes. People go, "Where have you been?" And I go, "I'm here every day." It means your settings aren't set quite right. So do that. You can obviously go to my profile page if you want to see, go back and review this interview, let's say down the road. Those are all in my archives there. So, all my stuff is there. I've been on Twitter since 2013. People can, if they want to waste their time and go all the way back, there's certainly plenty of stuff there in terms of what I've said over the years. And my letter, I do publish a macro letter that comes out quarterly. It's by subscription, so it comes with a cost. Anybody that would be interested in that, or might think they might be interested in that, can just direct message me on X, and I'll respond with the details.
Great. That sounds fantastic. I'll put a link in the description below to your profile on X. Thank you so much once again, David, for coming on and sharing your knowledge with the audience.
Yeah, thanks, Jesse. Happy New Year. I think I'm going skiing now.
Excellent. Have a great time. I'm here in Serbia. Basically, it's like a war zone here. People lighting off fireworks left and right. I will be dealing with that well into the early morning hours. But you have a great New Year's as well, my friend, and talk again soon.
Okay. Thanks, Jesse.
And thank you for joining us today. As a reminder, this episode is brought to you by ARC, silver, gold, osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.